820 million ounces. That's how much silver has vanished from global markets over the last 5 years. To put that in perspective, that's equivalent to an entire year of global mine production gone. And right now, in December 2025, the Silver Institute just confirmed what every smart money investor already knew. We are entering the 5th consecutive year of structural deficits, and 2026 is the year this powder keg explodes. If you're not positioned in silver right now, you're about to watch one of the greatest wealth transfers in modern history happen without you. The next 14 minutes will show you exactly why $100 silver isn't optimistic. It's mathematical. Here's what's happening right now that should terrify anyone not paying attention. The Silver Institute released their annual World Silver Survey on November 13th, and the data is absolutely jaw-dropping. They confirmed that 2025 is the 5th straight year of supply deficits, with a shortfall of 95 million ounces this year alone. But here's where it gets really interesting. That brings the cumulative deficit from 2021 through 2025 to approximately 820 million ounces. Let me say that again in a way that hits home. 820 million ounces of silver have been consumed beyond what miners could produce in just 5 years. The Investing News Network reported on December 15th that this is not a cyclical shortage. This is what experts are calling an entrenched structural deficit, tied to a multi-year mine supply shortfall that simply cannot keep up with rising industrial use and strong investment demand. And just 2 days ago, Saxo Bank's head of commodity strategy, Ole Hansen, published an analysis titled Silver's Breakout Year, From Monetary Hedge to Industrial Powerhouse, where he stated explicitly that the physical market is showing a roughly 120 million ounce deficit in 2025, and forecasts generally point to a continued deficit in 2026. This isn't speculation anymore. This is official market data from the world's largest commodity institutions. So let's break down exactly what's happening here, because most people don't understand the severity of what a 5-year consecutive deficit actually means. According to comprehensive market analysis compiled from the Silver Institute and Metals Focus, global silver demand in 2024 hit between 1.16 and 1.21 billion ounces. Global supply, only 1.01 to 1.2 billion ounces. That's a deficit of 148.9 to 215.3 million ounces in 2024 alone. Now here's where this gets absolutely critical. The Silver Institute notes in their November press release that even though global silver demand is expected to decline by 4% year over year to 1.12 billion ounces in 2025, the market has remained in deficit. Why? Because mine supply is essentially flat at 813 million ounces. It's not growing. It can't grow. And demand is still outstripping supply by nearly 100 million ounces, even in a year where demand is supposedly declining. But wait, you might be thinking, if demand is declining, won't that solve the problem? Wrong. Dead wrong. Because that 4% decline is coming from jewelry and bar and coin demand being crushed by record high prices. Industrial demand? That's a completely different story. The Silver Institute confirmed that industrial demand still hit 665 million ounces in 2025, and that number is only going up in 2026. CNBC reported just last week that silver has outpaced gold in 2025, with growth of about 71% compared to gold's 54%. The metal reached a historic peak of 57.16 per troy ounce in late November, marking a 90% increase year on year. And right now, as I'm recording this, silver is trading above $66 per ounce. That's a new all-time high, breaking records that stood since 1980 and 2011. Now here's the part that almost nobody in the mainstream financial media is explaining. And it's the reason why this deficit is truly structural and can't be fixed by higher prices. According to the Investing News Network's interview with Peter Krauth from Silver Stock Investor, approximately 75% of silver is mined as a byproduct of other metals such as gold, copper, lead, and zinc. Let me explain why this is absolutely critical. In a normal commodity market, when prices go up, producers increase production. It's basic economics. But silver doesn't work that way. The vast majority of silver doesn't come from primary silver mines. It comes out of the ground as a secondary product when companies are mining for copper or zinc or lead. And here's the kicker that Krauth explained in his interview. If the silver that you produce is a small portion of your revenue stream, you're not motivated to try to produce more silver just because silver prices are high. In fact, he pointed out something even more counterintuitive. Higher silver prices could actually result in less silver coming to market because miners might switch to processing lower grade base metal material that was previously uneconomical. That lower grade material might contain even less silver, so we've got a situation where silver has more than doubled in price in 2025, and mine production is still flat at 813 million ounces. It's not responding to price signals because it can't, and it gets worse. On the exploration side, Krauth noted that it takes 10 to 15 years to bring a silver deposit from discovery through development and into actual production. So even if a company discovered a massive silver deposit tomorrow, it wouldn't help the supply crisis until 2035 or 2040. The reaction time to higher prices is glacially slow, and according to Krauth, I think we're going to see these shortages and tightness persist. But here's where the story gets even more dramatic. And this is the part that should genuinely concern anyone who thinks they can just wait and buy silver later when prices dip. The physical vaults are emptying at an alarming rate. CNBC's deep dive into the silver market, published December 10th, revealed something absolutely stunning. London's vaults have been emptying rapidly for the past few years. Here are the exact numbers. In June 2022, the London Bullion Market Association held 31,023 metric tons of silver. By March 2025, volumes had fallen by around a third to 22,126 metric tons. That's the lowest point in years. And it's not just London. Saxo Bank is Ole Hansen noted that inventories at the Shanghai Futures Exchange recently hit their lowest level since 2015. Now, Paul Sims, head of EMEA ETF Fixed Income and Commodity Product Management at Invesco, told CNBC something that should make your jaw drop. Some people were having to transport silver by plane rather than on cargo ships to meet delivery demand. Think about that for a second. Silver dealers were so desperate to meet delivery obligations that they were air freighting metal instead of using normal shipping methods. That's not a normal market. That's a market in crisis. And here's the most disturbing part from that CNBC report. In October 2025, the squeeze was so severe that to borrow silver overnight was costing 200% on an annualized basis. Rona O'Connell from StoneX told CNBC, at one stage, to borrow overnight was costing 200% on an annualized basis, so a lot of people were very stressed, to put it mildly. Lease rates hit 40% in 2025, according to Comprehensive Market Analysis. That's a historic high. When you see lease rates like that, it means one thing and one thing only. There's no readily available physical metal left in the system. If you're still watching right now, do me a quick favor, smash that subscribe button so this information keeps coming to you daily. Most people who watch this far end up thanking themselves in 6 months. When silver's sitting at $85 or $100, and they got positioned early because they actually paid attention. I cover breaking precious metals. Intelligence like this every single week. And YouTube's algorithm only shows my videos to people who actually engage with the content. So hit subscribe right now and let's keep going, because the next section is where this story gets really wild. Here's the unique angle that I haven't seen a single other precious metals analyst properly explain. And this is what makes me absolutely certain that 100 silver in 2026 is not just possible. It's inevitable. We are witnessing the first time in history where silver, as industrial demand and monetary demand, are spiking simultaneously while supply is structurally capped. Let me break this down. The Silver Institute just released a report in December titled Silver, the Next Generation Metal. In it, they explain that heavy demand for silver through 2030 is coming from the clean tech sector, mainly solar and electric vehicles, and emerging technologies such as artificial intelligence and data centers. This is why the US government included silver on its list of critical minerals in 2025. Now here's where it gets really interesting. Frank Holmes from US Global Investors told the Investing News Network in December that silver's ability to be a transformative part of renewable energy, particularly in solar panels, is an outsized factor in the current price rally. And Peter Krauth pointed out something that should blow your mind. About 80% of data centers are located in the US, and their demand for electricity is expected to grow by 22% over the next decade. AI alone is expected to drive electricity demand up by 31% over the next decade. But here's the kicker that nobody's connecting. Over the past year, data centers in the US have chosen solar energy 5 times more than nuclear options for powering their operations. 5 times. So you've got exploding AI infrastructure that needs massive amounts of electricity, and they're choosing to power it with solar, which is the most silver-intensive energy source on the planet. And it's not just solar. According to CNBC's report, at the moment, a standard electric vehicle has about 25 grams of silver. But if the industry moves to solid-state silver batteries, each electric vehicle might require a kilo or more of silver. That's a 40x increase in silver demand per vehicle. The Silver Institute confirms that over the past 8 years, industrial demand for silver has grown steadily from nearly 31,000 metric tons in 2016 to over 36,000 metric tons in 2024. So let's get brutally practical. What does this actually mean for you and your money in 2026? First, understand that we are watching supply-demand fundamentals that occur maybe once in a generation. Multiple major analysts are now openly calling $100 silver inevitable. According to market forecasts compiled from UBS, BNP Paribas, Solomon Global, and Clem Chambers, the consensus target for 2026 is $100 per ounce, representing a 56 to 64% appreciation from the current $61 to $64 range. But some analysts are going even further. Michael Oliver scrapped his prior $60 to $70 target and now projects $100 to $200 within 2 quarters due to structural factors. Ronald Peter Stoffelo from Incrementum AG stated that triple-digit silver is inevitable, citing vanishing inventories. And one anonymous street analyst even threw out $275 as a potential target, citing scarcity from battery technology investments. Now, I'm not saying you should base your entire investment thesis on the most bullish targets, but when you have institutions like UBS forecasting $65,000 with potential spikes higher, and Citigroup predicting silver will reach upwards of $70 in 2026, and multiple respected analysts calling $100 inevitable, you need to pay attention. Saxo Bank's Ole Hansen made a critical point in his December analysis. For manufacturers of solar energy, electric vehicles, AI, and data centers, silver is essential but represents a relatively small share of total production costs. Running out of supply is not an option. This creates what economists call price inelastic demand. Translation: these companies will pay whatever it takes to get the silver they need because the alternative is their entire production line shutting down. Drop a single word in the comments right now, type deficit if you think we are heading to $100 in 2026, or bubble if you think this is all hype and silver crashes. I read every single comment and it tells me exactly what deep dive to do next. Plus, engaging helps this video reach more people who desperately need to see this information before it's too late. Now, in the interest of complete transparency, I need to show you the bear case, because ignoring it would be intellectually dishonest. Kitco News published a major interview on December 7th with Avi Gilbert, a veteran technical analyst who accurately called the 2011 gold top and the 2015 bottom. And Gilbert is warning that what we're seeing right now might actually be the end of a very long cycle, not the beginning of a new supercycle. Here's his exact quote. "I believe we are heading into the end of the cycle. 2026 probably will provide us with the end of this long-term cycle in gold and silver, and potentially kick off another multi-year bear market." Gilbert believes that silver could see one final rally to $75 to $80, but after that, he's expecting a prolonged correction that could ultimately drive silver back significantly over several years. His argument is based on technical analysis and Elliott wave theory, and he's dismissive of fundamental analysis, stating bluntly, fundamentals really do not matter. They are usually coincidental factors. He points to the post-2011 period as proof where, despite strong supply-demand arguments, gold and silver prices fell for years. Now, here's my take on this. I think Gilbert's technical analysis is worth considering, especially given his track record. But here's where I differ. The structural deficit we are seeing now is quantitatively different from anything we saw in 2011. In 2011, silver hit $49 on speculation and momentum. There was no 5-year cumulative 820 million ounce deficit. There was no critical mineral designation. There was no AI revolution driving data center solar demand. The fundamentals today are objectively stronger than they were in 2011. Plus, even if Gilbert is right, and we see one more rally to $75 to $80 before a correction, that's still a 15 to 25% gain from current levels. And if that rally happens in the first half of 2026, you still have time to position and profit before any potential top. So what do you actually do right now? 3 concrete action steps. Step 1, physical silver should be a core holding in your portfolio going into 2026. The Investing News Network's Peter Krauth stated he views $50 as the new floor for silver, and gave what he called a conservative forecast of silver in the 70 range for 2026. Focus on recognized bullion products. American Silver Eagles if you're in the US, Canadian Maples if you're in Canada, or generic rounds from reputable mints like Asahi or Sunshine Minting. The premium doesn't matter as much as the metal weight. This is about ounces, not numismatic value. But here's the critical point. You need to understand that we are in the early stages of a physical shortage. CNBC's reports show that London vaults are a third lower than they were in 2022, and Shanghai inventories are at 2015 lows. When the mainstream finally wakes up to this story, when CNBC starts running segments about silver shortages, when your neighbor starts asking how to buy silver, it will already be too late. Premiums will spike, delivery times will stretch to months, and you'll be competing with millions of retail investors all trying to buy at the same time. Step 2, for those who want exposure without storage concerns, the iShares Silver Trust, SLV, is the most liquid option. According to the Silver Institute's press release, exchange-traded product holdings are up by roughly 18% through November 6th, generating a year-to-date rise of 187 million ounces. Saxo Bank's Ole Hansen noted that ETF inflows have reached around 130 million ounces this year, lifting total holdings to roughly 844 million ounces, an 18% increase. This is real institutional and retail capital flowing into silver. But understand the trade-off. Paper silver gives you price exposure and liquidity, but in a genuine physical shortage scenario, paper and physical can decouple. SLV gives you convenience and easy exit, but it doesn't give you the insurance policy that physical metal provides when everything breaks. Step 3. Silver mining stocks are the highest risk, highest reward play in this space. When silver moves 10%, quality miners can move 30 to 50% because of operational leverage. The challenge is picking the right companies. You want producers with low all-in sustaining costs, strong balance sheets, proven reserves, and ideally some growth projects in the pipeline. According to the Silver Institute, the average all-in sustaining cost for the first half of 2025 fell 9% year over year to $13 per ounce. That means at $66 silver, primary silver miners are making over $50 per ounce in margins. That's a profit machine. If you don't want to pick individual mining stocks, consider a diversified silver mining ETF. The key is to size this position appropriately. Mining stocks are volatile, and you need to be able to stomach 20 to 30% drawdowns without panicking. So here's where we are. The Silver Institute has confirmed the 5th consecutive year of structural deficits. The cumulative shortage from 2021 through 2025 is 820 million ounces, equivalent to an entire year of global mine production. London vaults have fallen by a third since 2022. Lease rates hit 200% annualized at the peak of the October squeeze. Industrial demand from solar, electric vehicles, and AI data centers is price inelastic and growing. Mine supply is flat because 75% of silver is a byproduct, and CAN't respond to price signals, and multiple major institutions are now calling $100 silver inevitable in 2026. You have two choices right now. Choice 1, you treat this like every other financial news story you've heard, think that's interesting, and then move on with your day. And then in 8 months, you watch silver cross 100, and you kick yourself for not acting when the data was screaming at you to pay attention. Choice 2, you recognize that you're getting information right now that most retail investors won't understand until it's already priced in, and you position yourself accordingly. You buy physical silver while premiums are still reasonable. You allocate to SLV or a mining ETF while the trade is still early. You understand that we are witnessing a structural supply crisis that mathematics says must resolve with significantly higher prices. I can't tell you what to do with your money, but I can tell you this. An 820 million ounce deficit over 5 years is not noise. It's not speculation. It's not a narrative. It's documented fact from the world's leading silver industry research organizations. And when supply and demand are this out of balance, price is the only mechanism that can restore equilibrium. If this video gave you clarity on what's actually happening in the silver market right now, smash that like button and subscribe so you don't miss the next update as this story develops. I'm tracking this market every single day. And 2026 is going to be the year that separates the people who understood supply and demand from the people who thought fundamentals don't matter. The deficit is real. The shortage is accelerating. And $100 silver isn't a prediction, it's math.